U.S. stock indices powered to multiple all-time highs early last week, continuing the 2025 trend of record-breaking rallies. But Thursday and Friday brought a reality check as stocks reversed on renewed economic worries, ending the week off those peaks. Looking ahead to the first week of August, another wave of second quarter earnings arrives with market-moving reports from tech, industrial, and healthcare giants. You've come to the right place. This is CB3 Financial's weekly update, and it starts now. Welcome back to the CB3 Weekly Update, where we turn the spotlight on Wall Street's wildest moves with insight, energy, and a forward-looking edge. So let's break down where we've been, what just happened, and what to watch for as we roll into the first full week in August. So the market continues its record-breaking ways last week, notching lifetime highs as high as 64.12 on Tuesday, July 29th, marking its 15th record close of the year. The NASDAQ Composite jumped above 21,260, posting its fourth record close in just 2 weeks. And the Dow Industrials hit an intraday all-time high of 41,053, briefly topping its January record before pairing gains. If you remember, the Dow has been lagging the S&P and the NASDAQ in this post-April move higher off the very, very temporary bear market that we had for about 28 hours in early April. All right. So what changed? You never know what the market's going to do, right? It just doesn't move in a straight line. I wish it did, folks, but it just doesn't. So by Thursday, investors turned risk averse as a fresh global growth concern hit a number of bond yield sentiments. Okay. And the Dow dropped 1.2%, its largest drop in nearly 6 weeks, and the first full 1% move in that same amount of time. So the Dow and the S&P and the NASDAQ, especially S&P and NASDAQ, have been moving higher, but never notching those 1.3, 1.7% move higher. They were just kind of nudging their way higher, but that definitely turned on Thursday with that 1.2% drop. Friday didn't bring any relief as mega cap tech saw profit taking, while a mixed employment report, as you know, the non-farm payrolls is the first Friday of the month, and that spooked investors, especially because the Fed has said they're not going to drop interest rates, and many in the industry, and I would be one of them, saying, you need to get in there, Fed, and call a special meeting and drop at least 0.25%, maybe even 50 basis points, and we will see if that happens, but I'm not expecting it. So despite these early highs in the week, the S&P finished the week down 1.5, again, because the moves on Thursday and Friday were bigger to the downside than the upside moves Monday, Tuesday, and Wednesday, and I just illustrated why that was the case. So volatility crept up, but this is just a classic August pattern, folks. August is generally the most benign of all the months in the year as far as the trading environment goes. Summer markets, thinner volumes, people on vacation, market makers in their fourth home somewhere. All right. And don't let that spook you, because this is normal behavior for an August. So earnings still provided plenty to cheer about. Amazon delivered robust e-commerce gains, sending shares higher. Tesla and Caterpillar beat revenue expectations. I don't know if you saw me mention this with a previous tweet, but Caterpillar has actually beaten over the last 3 years 5 of the Mag 7 stocks. And we are looking for an entry point for Caterpillar in CG this coming week. So it's definitely on a tear. 75% of the S&P 500 companies have now reported, with roughly 80% surprising to the upside. And you know from watching CB3 Live that 73% surprising to the upside is the magic number. This is a full 7% beat on that to date. And I will have more for you on the CB3 Live update, which will be a week from Thursday. So what are we going to see coming up ahead this week? This week brings another flood of earnings. Keep your eye on quarterly results from companies like Eli Lilly, Starbucks, Warner Brothers, ConocoPhillips, and PayPal. The jobs data and the July ISM numbers will give the market's clue on the path of the Fed. But what really happened late in the week that caught my attention is that we had another Fed governor dissent from Jay Powell, and one resigned. So now there is an open seat on the Federal Reserve, and Donald Trump is going to appoint someone for that seat and could name them chairman. This would be the first time in history where there is a new appointee that's waiting to be approved by Congress, but might even take on the de facto role of acting or proxy chairman. It is a very nuanced, unusual situation. So AI and consumer spending things will keep driving the headlines. I don't expect that to change, especially as retailers begin issuing guidance for the back-to-school season. So even with a recent pullback, the long-term trend remains higher. This happened because of the April downturn, because of the tariffs, and yet the market just rocketed out of that with that big 11.5% day in early April. And it was tough for some money managers, and we're in that group where we were positioning defensively. That's what we have to do when the market turns down as viciously as it did. And then it just turned on a jackknife V-shaped correction. And we know the rest of the story now, multiple lifetime highs. So here's my take. Don't panic on these pullbacks, but don't tune out either, because there definitely are some concerns in what's going on in the market. And yet we remain fully invested with all of our programs. So that's where we stand right now. We will have an update coming later in the week. We will have another weekly update next Sunday. And actually, I see the overnight markets right now are actually slightly higher in Japan. That's a good thing. And then, of course, on Thursday, August 14th, will be the next CB3 Live. You don't want to miss that. As the earnings drama continues, as the tariff drama continues, it's just a really interesting time to be an investor, even in the slowest, sluggish month of August. Thank you guys for listening. We will see you next time.